Hey, good morning. Today is February 24, 2023. Just wanted to talk about one, where we are in the market, two, what I'm doing with the option strategy, and also wanted to review just kind of our bread and butter, technical, we'll call it observation. Let's say observation. So we'll get into that. That's about the 4 hour, the 9 to 1 strategy for those swing traders out there. So it's going to be, maybe a 15 to 20 minute presentation. Appreciate you tuning in, and I promise you will get something out of this. Okay. So let's start with just some technical analysis. All right, we're going to go to the monthly time frame, and actually we're on the weekly now, and let me just add that one in real quick. Okay, and we'll go to the month. We'll start with the monthly. Always try to start top down. Always start top down. All right, so we have a monthly chart, and currently we're in this month of February, and we're seeing some resistance levels up here, right around the 41.75 level. Market pulled up this month to 4,200. And is now kind of backing off from that level. Okay, so we'll mark that as an important level. Also noting the month of November, there was support here, monthly low here at 36, and there's a couple down here. We want to, basically these are kind of the same. The month of December had a low at 37.79, and so those are our big monthly kind of levels. Okay, on average, the ATR, I don't have that on right now, but the ATR is typically 300 points in this range. So where we are currently is, what I like to use is the fib tool, the retracement, and I'll get the last couple of lows and go up to the high like so, and that gives us an idea where the range is and where we are. So you can see, we hit these highs up here, and then the market has been backing off. Now we're about 61%. We're at the 618 level of these monthly highs and low ranges. So it gives you an idea where we are in that pullback. Our sentiment is still bullish. We put in a high here, market tested the range, didn't break it, so still kind of a bullish standpoint. All right, let's take that off so we don't get too junky, right? All right, so let's go down to the weekly level, right? And you can see that market is, came up to the highs. We're just getting a little more granular. Came up to these highs at 4,200, somewhere around there, and has now been pulling back, into the range that we identified on the higher time frame. We're about at the 618 level and still moving down. Okay, and let's go to the daily. You can see, we had a little tick up yesterday, but the market just blew past yesterday's low, previous day low, right? And we're still moving lower. Let's go to the 4. Excuse me. All right, we're still in our, we're just getting more and more granular. Don't get confused, okay? Now, what I like to do at this level is I like to look at the 4-hour ranges and the last, where high volume is. So we're looking at volume. These volume candles, big volume candles, are typically formed from 9 to 1. So you can see here we have huge volume compared to other time frames, right? From 9 to 1. So I like to measure that like this. Okay, so if this is the last 9 to 1 we put in. All right, let me remove that. Okay, this one here. We're gonna just do we're gonna use the extension tool. Okay, so that's the last 9 to 1. All right, now the thing that I've noticed over many years now, and I have back tested data on this, is that most of the time these volume ranges, high volume ranges, will continue on, right? And when they do continue, say if they're bullish, they continue up. If they're bearish, they continue down. When they do that, they typically make an extension. So watch, I'm getting the extension tool, fib extension, going to the high, and I'm gonna go to the close of that candle. Okay, and I'm gonna do that. Okay, and notice these yellow lines here, that's the 50% extension, and that's the 100% extension. Okay, meaning if you were if we're measuring this amount of risk from here to the open or to the high, this is 50% of that range, and this is 100%, a double of that range. Like very, very common, that frequent, that these ranges, these high volume 4-hour ranges that are formed from 9 to 1, they typically go on to close below the 50% extension level or the 100% extension level. I'm gonna show you a table that I keep. Okay, I'm gonna pull up a table, and this is showing you just the last extension. So I keep track of this, and for example, on 223, that the 9 to 1 range made a 50% extension close, and it closed below the 100%. And so you can see, like 80-90%. This is the last 10, and most of the time you get a close below the 50 and the 100. Okay, irregardless of what the market is, on a whole, on a big time frame, is doing, right? And so we only had one hit here on 2.7 where the market was breached, and on 2.1 you hit the 50% extension, but you didn't hit the 100% extension, and the market went on for a breach. So this is a really high probability observation, and you can use that for whatever kind of trading you want to do. Okay, whether it's swing trading, option trading, but it's a powerful observation that I've seen happen many times. I would invite you to do the same thing with your charts. Just look at those extensions that are happening from the high, these high volume 9 to 1 ranges. All right, so that's kind of where we are in the market. We have our lows here. Our highs are up here. We're about 50 to 60% pullback level in the monthly range, and market is moving lower, hitting extensions from the previous day's 9 to 1 range. All right. And okay, so what I'm doing is I do option trading, option spread, hybrids. So for the next few minutes, we'll talk about what I'm doing, how I do it, how I adjust it, all those things. So it's a strange looking thing, right? But it'll make sense to you when we get into it. All right, so right now I have on several different types of spreads. Okay, like on this wing side, I have a short vertical. In the middle here, I have a calendar, and on the call side, I have a butterfly. All right, now I know there's a lot of new guys out here, but for the folks that are a little more advanced, why am I doing that? Why not just put on an iron condor? Because you know that iron condors are high risk and low reward. Okay, meaning, see, I'm risking 600 here, and if I had on just the wings, I'd be risking the 600 to make, it's usually like an 8 to 1. So when you add these calendars, when butterflies in, say if you're staying in here to expiration, see that is giving me $620. If it lands here on expiration, that's giving me $1,200. All right, and I'm risking 600. So this is, if it gets up in here, it's a 2 to 1. Down in here, it's basically a 1 to 1. And if the market, moves lower, right? Say if it hits 385, I'm already thinking ahead. I'm already thinking right around here. My risk to reward starts diminishing. See that? Okay, I'm risking 600, but if the market were going to expiration, right, I'm only getting 300. All right, so I want to keep that. The main goal of my trading style is to keep that ratio, risk to reward, high. So when we get down in here, I'm probably going to add on another calendar, right? Very low cost, $225 cost. But look at what it does to my risk to reward. It brings that up to 800. Okay, as long as the market is staying in this area. All right. Now, what do I do with the shorts? Well, when I first start off, and I didn't do a video on this, but when I first start this type of position, typically what I'm doing is a 30 delta put spread, a 30 delta call spread. I put a butterfly at about 35 delta on the call side, and I put a calendar at about 30 delta on the put side. All right, and that is the initial position. So what you're seeing here is an adjusted position. So when the market moved down, the deltas on the call side went to 20, went from 30 to 20, and I'll show you that. And the deltas on the put side went from 30 to, like, it was getting to 40. All right, so when I start seeing like a discrepancy like that, like a 10 point, 15 point discrepancy between the put side and the call side, that's when I want to balance it out again. So I move my put spread from 30 delta to 20 delta. All right, let's take a look at the position. All right, so we're 50. We started at 60 days. We're at day 4 now, and so on the put side, this is the put spread that we just adjusted today. It went from 30 to we moved it to the 20 delta position. I don't add. That's the other thing. I don't add to, when people typically adjust, they go from 5, then they'll add to it. I don't want to add to it because I'm not getting what I'm banking on in this strategy is the high risk, high reward, low risk positions, like the calendar spread, all right, which is here, like the butterfly spread, which is up here, all right. I'm not banking on the put spread or the call spread. Those are low risk. Those are low risk, but high risk. Low reward, high risk, right? Low reward, high risk. I want to bank on calendar and butterflies, right? What I'm using the put spreads for, what I'm using the call spread for on the call side is the Vega, right? I want that negative Vega because that's balancing out the Greeks, all right? So what we have here is we have a big condor, but within the condor you have a call and you have a butterfly. This is the other side of the condor. Of the spread. This is the call side. Now, so that's what we have. On the put side, we have the put spread we just adjusted. On the call, we have, we have a calendar spread here at 49 delta. We have a butterfly, and we have a put spread, call spread, right? And as this thing gets even more, if the market continues to move down, in this, say that delta gets to 15 or 20, and I'm watching that. I'm watching the difference between the deltas between the puts and the calls. That's what tells me when I need to adjust. So if that difference gets big, that's when I adjust to keep the deltas neutral. And then I'll look at the overall picture, and I'll see, okay, this is, after that adjustment is made, then I look at the overall picture. Okay, how does my risk to reward look? Like right now, risk reward is 600. Risk is 600. So I'm okay. Right? I've neutralized my deltas. Right? Number 1, neutralize your deltas. And number 2, keep the risk to reward in your favor. Right? So right now, even though I adjusted this put spread, I don't need to move a calendar or add a calendar because the risk reward is good, and the profit is coming in. Okay, profit is coming in. All right, so and like I said, if the market continues to go, let's say it goes to down a little bit, 380, 387 or so. Okay, like right here, you can see that the edge is starting to get away from me. So that's when I might add one of those. So I have an alert set here at 386, right? Because I know that's when the, 10 points down, if we make another 5-10 point move, I might have to add a calendar, and then add a calendar or butterfly. We could look at that too. But at that point, what you're looking at is your theta to vega ratio. See, when we add the calendar there, right now we're really good because there's no vega impact on this position right now. All right, no vega impact. If we add the calendar, the vega starts to get away from the theta. You get to 2 to 1. That's not bad. But when you start getting the 8 to, more than that, like let's say we add a few calendars, right? See that now we're at 4 to 1. Okay, that's not what we want. We don't want any one of these Greeks to dominate the position as a whole. And so I'll wrap that up there. That's a lot. I know that's a lot to take in because you're dealing with 3 or 4 different, what people consider to be different strategies: butterfly, calendar, verticals, etc. They think of that as different, but I don't think of it as this different. I think of it as one position, and all I'm doing is modifying the position to control these Greeks as we approach expiration. And I'm also thinking about how much I'm risking and keeping that edge, right? Keeping it greater than 1 to 1 at any point in time. If you were, let's just look at the condor and then we'll close out. All right. So if you were to just look at the condor, let's take everything off. Okay, good. And then just look at it from a condor standpoint. So we're taking off everything but the shorts. Okay, so this is a 20 delta condor. And right now, it's very neutral, right? Theta's coming in. But look at the vega to theta ratio, 6 to 1. 6 to 1. So if we have a major change in volatility, that could really impact the shape of this curve. That's why I add on some things like the calendar. Okay, like say if you added just one calendar, neutralize that delta. Neutralize the vega, right? See, with 6 to 1, now with the calendar, basically neutralized. Okay. So, that's good, and then if I were starting off like this, see my max potential, if the market didn't move, max potential here is 500 and I'm risking 400. See, as opposed to if you just were in an iron condor, your max potential is 200 and you're doing a 1 to 1 here. But you got this problem. You got the vega problem. Now with the calendar, you're a little more than a 1 to 1, and you've neutralized vega, and you're bringing in the theta at 2 times the rate of Vega. Okay, 2x, 2 times as fast. That's the other advantage to learning how to trade multiple strategies, combining them into one option strategy. All right, I'm gonna cut it off there, and I hope you guys have a good weekend. We talked about a lot. Again, start small when you're learning how to do this stuff. Like these positions I'm doing are just a few, just a few contracts at a time. If you don't need to make a lot doing this, just enjoy the process. Just enjoy the process. It's not a rush job. The other thing is, finding what works for you is the other piece. Like, I really like this style because of trading, because it's relaxed. If the market makes a big move, like it kind of made a big move today, almost a 2-point move, 2% move. I'm not stressing that. I saw that coming. I made my adjustment, and I'm relaxed. I'm not sweating it. And there may not be a lot of money on a daily basis, but I think of it almost like the work that I'm doing, like adjustments or adding or taking off or moving, those little moves I'm making every day are the work. That's the work that it takes to win at the end of the month. The paycheck is at the end of the month, just like you want to work a job and you're getting paid monthly, but you got to do some work every day, a little bit of work every day to get that monthly paycheck. That's how I think about this. That keeps me from getting, off track. All right, guys. Talk to you later.